Welcome back. You're watching Midcap Radar on CNBC-TV18. Pull up the chart for Indian Bank. We've been highlighting that PSU banks have been doing exceptionally well in today's trading session. Indian Bank is up almost 4% today and has managed to hit an all-time high. We also have been highlighting over the course of the last week how all of these capital good plays have been doing. Pull up the chart for GE Vernova TND. The stock as of now is up almost 2%. It has been doing quite well over the last couple of sessions. In fact, in the last 7 days, the stock has surged by almost 10% at an all-time high today. Along with it is also Hitachi Energy. Of course, it has slipped in the red. It is trading with a cut of almost 0.4%. But nevertheless, that stock has also managed to do quite well. In the last 7 days, it's up almost 17%. And lastly, put the spotlight on BSE along with other capital market plays. This stock has managed to reach a fresh record high in today's session as well, up almost 1% today. But moving on then, let's also focus in on JNK India. The management is joining us now on the show. The company's revenue fell almost 16%, while margins contracted too. To discuss the quarter gone by and the outlook for FY26, we are now being joined by Dipak Bharuka, who is the whole-time director and CEO at JNK India. Well, Mr. Bharuka, good afternoon. This is Vamakshi joining in. Well, FY25 was not such a great year for the company, but what's your outlook looking at FY26?
Good afternoon, Vamakshi. Definitely, year 26 is we are quite hopeful considering the orders in hand. We are aiming at around 40 to 50% growth in the revenue. And if you see, we expect a couple of percent better margins and EBITDA for year 26. And definitely on the demand side, domestic as well as international demand, we see it's a robust demand we are seeing, which is expected to come in the next year, 4th quarter or something. And we are quite hopeful this 26 will be very good year for us.
And you saw a 1% decline in your revenues this time around for FY25. So what is driving the kind of confidence that you're seeing, 40 to 50% uptick in revenue? Where is this growth largely going to come from? Is most of your order book going to get executed in FY26 as well? And what about the order inflow then? Because that has been weak over the last 3 quarters at least.
So if you see, Vamakshi, we have order backlog of 1082 crore, 1082 crore. And last year, our order inflow was 933 crore. If you see by even a conservative estimate, most of our orders, 80% of them are supposed to be executed in this financial year. And from there, we are expecting we definitely will have 40 to 50% growth on the revenue side.
Understood that. So with the current order book, you're saying that FY26, you can see a 40 to 50% growth as far as FY26 is concerned. So that, is the visibility that you're getting from the current order book. But order inflow remains a bit of a concern, especially FY25. It appears to have been quite muted. So going into FY26, how does the order prospect pipeline look like? What is the typical win percentage for you? And at the end of FY26, where do you see the order book at?
See, I'll just correct you slightly. Our FY25 on order book, we did very well. If you see, our order book was 933 crore, which is compared to the year before that was almost 4 times more than what we did year before that. Definitely, order book was not a concern. Concern was, yes, on the revenue side, we
understand the majority of the orders you booked were in H1 and H2 was slightly slower, especially in terms of tendering, right?
See, if you see,
so the momentum didn't sustain in the second half.
Yeah. So on quarter, it is not fair to compare the order book. Yes, year on year, definitely we can compare. If you see the order bid pipeline, we have almost 4,000 crore plus bid pipeline. We are already quoted for some of 3-4 big orders which are likely to be materialized in the next 2 to 3 months time. And if you talk about the win percentage was typically, historically, we get around 30% of our order. Hitting rate is, strike rate is around 30%. And that gives a confidence that our order book is definitely going to be better than the last year.
So if we just, do a back of the envelope calculation, 4,000 crore is the pipeline. If you're expecting a 30%, strike rate, 1,200 crores is the order inflow that you're penciling in for FY26?
Yeah, exactly. A figure around that. If you see this some of this will may get this some of this will get materialized in this financial year. Some might go to the next financial year, but more or less your back of the envelope calculations are correct, and that is what we are anticipating in this financial year.
And how much of this order book that would come through in this financial year would account for domestics? How much would it be from the exports?
If you see in this year, as we had in the last year, we see this order book will be more dominated by the domestic projects. If you see a lot of some of the PSU projects which are going for the expansion are going to give us good order inflow in this year. But next year we are expecting more on the export front. We are likely to do well on the order booking. But this year it will be dominated more by the domestic order booking.
Okay, Mr. Bharuka, the other thing what you want to understand is out of the 4,000 crore order prospect pipeline that you mentioned, renewable energy, how much does that account, or is it kept separately? And what has been the progress as far as executing orders for that particular segment is concerned? And secondly, we want to understand EBITDA margins. You've guided for 100 to 200 basis points improvement in FY26. Is that accurate?
Yeah, that is on EBITDA guideline. You are right. What we have given the estimate is a couple of percent more than what we did last year. Now coming back to the renewable energy, we have executed some of the EPC project in the solar. We are doing India's first CBG based on-site hydrogen generation plant for one of our PSU client, which is expected to be commissioned in another 3 to 4 months' time. And we are also involved in bidding for many CBG projects, then electrolyzer-based hydrogen plants and green hydrogen refueling stations. And we are also partnering with the electrolyzer manufacturers to provide the end-to-end EPC solution plus O&M support for the green hydrogen plants. So last 2-3 years, if you see, this green hydrogen has been a little sluggish, but considering the bid pipeline we are having or the projects which are coming from the PSU, we are quite bullish on this green hydrogen market in the next year or two to grow exponentially.
Mr. Bharuka, if you could emphasize a little bit more as to, you mentioned you do both EPC as well as O&M services as far as green hydrogen is concerned. So what is the EBITDA margin differential between both of the services? Typically O&M slightly longer period and much better margins. Is that an accurate reflection?
See, no, in our case, it does not reflect accurately because when we quote together single.
Okay.
So O&M is not above 40. Generally, we are more up on the EPC base. This is first time we are quoting on the O&M services because tender requirement is along with the O&M only you can quote. So if we see, we are more on the engineering and supply market. O&M is now this PSU's client, particularly they are coming O&M as a part of the single tender. So margin percentage will not be able to comment specifically on O&M and supply part, but more or less it's the same what we do in overall business.
Sure, and let's look at some of your numbers. Then trade receivables actually increased by 50% this time around, and when we look at your net cash flow as well from operations, that is still in the negative territory, same as where it was last year. So when do you expect the the situation with respect to trade receivables to normalize, and what would you guide as far as the working capital is concerned?
See, if you see the trade receivable, they are mainly, our 80% business in the last year, revenue, if you see, has come from the PSUs. And yes, there are some delays in the receivables, particularly when you work with the PSUs. But if you see this year, our 80% of the revenue is going to come from the private client, and their receivable situation is much better. As far as working capital is concerned, of course, our requirement of working capital is increasing day by day. It is mainly because of the new order inflow of the last year, what we had, and this year, what we are anticipating. So we are making, but as of now, we find we have enough capacity to take care of the working capital for all our ongoing projects and the future orders we are expecting.
Sure, and what about your cash flow then? Will we see that become positive this year, as you're expecting very good growth in the revenue and better working capital cycle as well? So will that be positive this year?
Definitely we will be very close to being positive. We may take a year or so to become exactly positive, but then yes, in next couple of quarters we will see a significant improvement in our cash flow.
And your employee expenses have actually declined by almost 88% on a year-on-year basis, 78% sequentially in Q4. So can you help us understand what actually led to this sharp fall? I understand there was some ESOP related, the ESOP was stopped or something like that in the fourth quarter. So can you elaborate on this, and what would be your employee cost as a percentage of revenue going into FY26?
See, if you see, we have basically, because we as a management, we felt that the results were not up to the expectations. We have deferred the increments, which from the employees' costs, we are given now some new targets to the employees, and definitely that has reduced our employee costs in the last financial year. But of course, that's not something which is really bothering us. We will have employee costs similar to this, irrespective of the order or revenue, because see, when it comes to the engineering or procurement or project management, our employee cost does not go up in the same proportion as our revenue. So as we are expecting a higher revenue in this year, our employee costs may not move by that same percentage. Like if we are expecting 40-50%, our employee cost is likely to move up by maybe around 15 to 20%.
Understand that. Thank you so much, sir, for joining us, giving us a sense of how exactly business panned out as far as Q4 is concerned and the outlook for FY26. Thanks once again. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.